I've mentioned this, time the gap trades, Rule 5 on page 37. A market that cannot close the gap will continue in the direction of the initial gap. And this is important. The gap trade should move positive within 5 to 10 minutes. Should this not occur, you must exit the trade immediately. I'm even more time sensitive than that. I'm aware, and most full-time S&P traders are very aware of the risk involved. If I sell a gap up and time goes by and it doesn't start to come down, guess what's going to happen? It's probably going to go up. And it's not going to go up slowly. It's going to break out and scream higher. And at that point, it's going to be all buyers. Now, I'm short. I got to be a buyer to take my loss on that, right? Well, I don't want to join that crowd. I want to get out and hopefully even reverse before it goes. So what I do is I time it. I'll give it X amount of minutes, maybe 5 minutes, maybe 7 minutes, whatever. And I want to see a profit at that point. If it doesn't happen, I'm out of there. What occasionally I'll do is, if I still think I'm right, I may sell another one and average the price up. But that second one is so close to where my mental stop is that I'm out the second it doesn't start to come down then. And what this does is it raises the average price, and it does increase the risk, obviously, but the risk on the second one is so small because often I'm right on top of it that it's minimal. And of course, if it does work out, it makes it twice as good. Now on page 38, we have a case of that gap not being filled. And here, you're not really sure. When it first gaps down, you don't have a lot to work with. You have a gap down. If you do buy it, you start to get some upward progress in the first 4 or 5 minutes. It's looking okay, but then it comes back on the whole thing. Once it comes back, it's no good anymore. Once it starts to do things that it shouldn't do, it's no good. And what do you have to do? You have to get out right away because it's only going to get worse. If you wait, in this particular case, you're looking at maybe 400 points on page 38 on that chart of roughly 70 down to 66. It's just going to get worse. And you know what you're going to end up doing if you do try to ride it out is you're going to get out at an extreme. When it gets to the point where you just can't take it anymore, you're going to call your broker and say, sell me out, and you're going to get filled at the very low. And of course, then there'll be that bounce. And you see this all the time. You know, I got out at the worst possible price, and then it went my way. So rather than have to live through that, watch the trade carefully, and once it doesn't start to work out, bail out quickly. You'll find people say to me, well, how often do you win or lose? The percentages aren't that important. You can win 10% of the time and make a lot of money, like people do on long-term day trading sometimes, and make a lot of money because the winners are so much bigger than the losers. On the other hand, if your losses are a lot bigger than your winners, the numbers aren't going to work in your favor. And you need to pay attention to this. Am I keeping my losses small? And what is small? Well, that's dependent on where the market is, what the volatility is like. These days, it's hard to keep an S&P trade much under 100 or even 200. But there's got to be a point out there where you don't let it exceed that. Now, Rule 6 on page 39 is be prepared to reverse on gap trades. And what that means is you're playing the probabilities, but if they don't work out, it'll probably go the other way. And it won't just die, it'll go. In other words, it gaps up, you sell it, it can't come down, time passes, a base is built, it'll go up. And I've had trades where I reversed right in the nick of time when it's in that consolidation, or I've gotten out right in the nick of time, and I'm so thankful to have a small loss versus the big loss it would have been if I had held on. You have to be fast doing this type of trading. an illustration of that large gap not being filled is on 41. You come into the market, the Globex is way up, the news is very bullish on the day. You get the gap up and it doesn't come back. Or you can test the waters by selling one and seeing what happens. Very often, I'm a multi-lot trader, but I won't do ones, but two is my minimum. I'll do a 2-lot just to see what happens. And if that 2-lot isn't profitable over, say, 5 minutes, it's giving me some very valuable information. And really, I don't mind taking a small loss on that. And I know the question you have, which is, well, why not just watch it? The reason I don't watch it, and I put the 2-lot in, is that when there's money involved, it shows you something in a way that you'll never learn from paper trading. And as evidence of this, what you might do sometime is take a 1-lot, you go out to the refrigerator and you make a sandwich and you watch the market. Well, take a 10-lot, you won't feel like eating anymore. So that's the point I'm trying to drive home, that where it's real money at stake, it totally changes the way you think about the market. And your job is to have that discipline and the presence of mind not to panic when inevitable counter swings come in or bad things start to happen. And it happens to everybody because of the money involved. Now, one way not to do that is to not think about the money, which is easy to say, but it's difficult to do. Another way to do it is to keep your position small enough that adversity is not going to cause you to get out. Very often people say to me, well, why don't you do 50 lots and 100 lots? And I say, well, why don't you? Because I know what that will do to a person when the money becomes too important. It will cause you to lose all reason, and you'll just start to trade in a really crazy fashion. And that even still happens about once a year if I get in a bad trade or I get in over my head or everything starts to go wrong. It's like I'm not even looking at my rules anymore and my time and price. I'm just throwing orders in. And that is inevitably a bad day. Here we have the sell in reverse on page 42. You fade the gap down thinking it'll go up. It starts to go up, it starts to come back on you. You realize it's not going to work, and you go the other way right away. Then you'll get the fast trend. You grab the profit and leave. But whenever you get, as in this case, off the high, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 minutes straight down, you're going to get a bounce, almost always. It may be 12 minutes, it may be 7 minutes, it may even be 15 minutes, but it won't be 2 hours without a bounce. You'll have a bounce somewhere. That's when you want to get out before the bounce comes in. I'd mentioned Rule 7, track all trades in both 1-minute and 5-minute bars. By taking a longer viewpoint using the 5-minute bars, you can see the overall trend better. However, the heart of the sniper trading relies on the 1-minute bar, which helps you manage the risk. And the longer the time frame, you got to remember, the greater the potential profit or risk. So if you're going for larger profits, you're going to have to live through some of the counter trends. If you're going for smaller profits, you can get that one-way trip I've been talking about. And again, on 44, I've got the trend down. And once the trend is over, either in the morning or the afternoon, like I said, it's over and you have to move on and wait for the next trading session to occur. Not to do that means you're probably going to be trading in a period of time where it's just choppy. And just look at what happens when we get in the lunch hour very often, the 12 to 2 East Coast time. And you'll see that very often the market really isn't going anywhere in that period of time. And 45 is a continuation of that, where it's the same day, in fact. Actually, this was a very big day down at the beginning of 98. Then the real trend occurred, and you got a leg, you got an equilibrium, you got a much bigger second leg, and it got overdone. When you have these big trending days, it will get overdone, and the reason is first the little guys have to get out, and as it progresses, the funds and the big players can't take it anymore, and now they have to get out. And when that happens, you have one of these bloodbaths to the downside, or it can happen to the upside, of course, too. But I love to sell because it seems that the breaks are so much faster than the rallies. Not always, but over the years I've noticed the breaks tend to be very fast, and it doesn't come back from those breaks either very often. Again, on 46, we've got the trend down. This is in the afternoon. And you have to learn to start identifying these things before really you even attempt this type of trading, is just to look at it on paper and see the trends. Before you start to risk money on these type of trades, though, you've got to psych yourself up in terms of what am I going to do, when am I going to do it, what am I looking for, and so on before you get in. You don't want to make up the rules once you're in the trade, because then what tends to happen is you tend to become most euphoric when you should be most cautious, and you tend to become most cautious when you have a reason to be euphoric. So what you have to do is keep your head about you when you're in one of these trades. Know what you're looking for. Don't ask for too much. You know, it's the old saying, the bulls make money, the bears make money, the hogs get slaughtered. Having said that, you have to go for the big trends, the big days when you get them, because not every day will be a big money-making day. A lot of days you get chopped up and you lose what you made on a small winning day the prior day, so you haven't really made any headway. So I'm a firm believer that when you get that good trend and it's going your way, you can't say, well, I've got my 100 points, I'm going to take it and leave. If it's a 500-point move, get the whole 500. You're going to need it for the bad days. And I think you'll see that that's true. On page 47, I've got a break on the first leg. I've got an equilibrium, and I've got a target buy on the downside. I haven't gotten into the specific measurements yet, but what we do is we measure the first leg. In this case, it was 950 down. Now, this is why random moves are not good to measure, because if you get 100 points one way, it doesn't mean it's a major move. But if you get 900 points, it means the market wants to go somewhere. It's serious about getting there. One of the top traders, who was one of my mentors, in fact, over the years, did all this on an intuitive basis in the pit. He would see the break, he'd watch it break, he'd wait for some buying to come in, and then he would sell and sell and sell. And when the bottom fell out and everyone was panicking, selling, he'd be buying them all back. And that's really what this is, except now, years later, I've been able to quantify what he did on an intuitive basis over 10 years ago. So here you get the 15-minute break on page 47. You measure the leg. And this is, by the way, is why you don't want to sell once that first leg is really underway, because the problem is you'll end up selling the bottom of the first leg. The inevitable counter trend will come in, and now you'll have paper losses on that, and you're apt to get out at a loss in what's really a big money-making opportunity.